So welcome to Learn by Choice. In this video, we are going to talk about the recent Reserve Bank of India measures on consumer loans or retail loans, and we are trying to understand the implications of the risk weight, the hike made by the Reserve Bank of India, and the challenges to the Indian economy and the banking sector and to the borrowers. So the RBI action is not taken very in the right note by the investors, and the shares of the banks and non-bank finance companies, it has fallen. This sector has seen huge selling pressure post RBI action. So actually the announcement has come on November 16th, 2023. The RBI increased the risk weight on retail loans or consumer loans provided by the banks and NBFCs. Not only consumer loans, but this is also applicable for credit card receivables also. This rule is applicable not only for new loans, but also the previous loans or the old loans. Earlier, the banks had the risk weight of 125% for this segment of loans, and NBFCs had 100%. Now the risk weight is increased by 25%. Now in case of banks it is 150%, and in case of NBFCs it is 125%. So the risk weights are allocated by Reserve Bank of India for all loans and other investments or other assets of the banks, and these assets are weighted by multiplying with a risk factor percentage reflecting the respective level of risk of loss to the bank. In case the investment is going bad or the loan is becoming bad, what will be the percentage of loss to the bank? So the risk weight percentage is calculated, differs from loan to loan or investment to investment. For example, the risk weight may be different for housing loan, it may be different for personal loans. It may be different for investment by banks to the government securities, maybe in other kind of securities or asset classes. So the steps of RBI, it's all preemptive steps taken by someone, or in this case the Reserve Bank of India, based on some expectations or anticipation. It's a preventive measure actually. The finance minister of the country also supported the RBI action of increasing the risk weight. So the measures of RBI are calibrated and targeted. Like MSME loans, education loans, housing, vehicle loans, they are not a part of this measure of RBI. Basically, the action of RBI is trying to bring some sustainability. The RBI actually cautioning the banks excessive exuberance or over enthusiasm in giving loan under this particular category. Yes. So even the Honorable Finance Minister's support also, it's adding endorsement to the central bank's actions. So RBI's alertness is a very crucial factor in maintaining the stability, Indian economy stability. So the goal of RBI, the action is not merely it is coming out of regulations, but it is trying to forge or foster a stable and sustainable financial environment. So what it happens is, now because of the RBI action, there may be higher capital requirements for banks and NBFCs. The collateral free loans are very riskier loans, in the sense that since there is no collateral, and in case of any loss or in case the borrower default and there is no asset to fall back upon by the banks to recover the loans. So the objective of action of RBI is to ensure the sustainability in the lending practices adopted by the banks. It is so that the RBI is asking the banks to increasing the risk weight for this particular sector of loans. The risk weights is part of the bank's risk management strategy, controlling the credit created by the commercial banks and FIs. So that's why the risk weights is forming part of the RBI action. So the goal of any risk management, even in our life and even in the financial institution, is to maximize the returns. In banking operation, they keep the risk management as core, as the essence of all kind of their activities by adopting the risk weights. The risk weights, as I mentioned to you, it's all the tools that banks are using to manage the credit risks. Assessing and mitigating the risks to ensure that banks operate within the acceptable set parameters of the RBI regulations. So the risk weight differs, and it is actually allotted for each category and type of asset or loan, and RBI assigns the risk weight based on the perceived credit risk, based on the probability of loss. And even the credit risk exposure policy of the bank is about quantification of the possible or the highest potential financial loss to the bank, which may face in the event the borrower is not repaying the loan. Dependency of NBFCs on bank borrowings. It's the NBFCs, they borrow from banks for further lending to the consumers or retail borrowers, which is adding further risk to the lending ecosystem. So even in October 2023 monetary policy, Reserve Bank, they also raised flags or concerns about the high growth in the consumer credit. So the NBFCs now, they have to strengthen their internal surveillance mechanisms to monitor this kind of loans. And also they have to increase the scrutiny level of each and every loan application received under this particular category. The RBI measure also emphasizes the importance of heightening the vigilance mechanism framework within the financial institution. So the RBI action is based on pure data. The personal loan by financial institutions in the last 6 years, it has actually tripled. If you see, the personal loan constitute nearly one third of the entire loan book, which was only 21.5% in the year 2017. The rating agencies, Moody's, they actually give a lot of insight about the Indian and world economy. They foresee that there will be a potential spike in the credit costs of the banks. And also, going forward, the lenders, the banks and FIs may not be showing much interest in giving further credit to the consumer loan growth appetite. So the rapid growth in the unsecured segment of loan has seen massive spike in the past few years because of few factors like shift in demography and Indian economy is getting formalized and high income of the people borrowers, and also which leads to high purchasing power, and the prominence of fintech they play a very important role in providing the ease of lending, ease of credit, and also digital payment ecosystem built by the India stack. And the delinquencies, the loans which are not repaid are more, that is also observed recently, and especially the loans which are less than 50,000, the delinquencies are more. So delinquencies indicate the percentage of loans that are overdue and are not repaid within the specified time frame, and each and every loan there are set obligations for the borrower to repay. So the RBI is actually responding based on the observed trend and based on the data and based on the associated risk with a particular kind of loans. So even if you see the loan book, the personal loan book, the 1 lakh category, the loans which are up to 1 lakh, it is constituting 85%. Major chunk is from this particular segment of loans. So the people are borrowing more, personal loans are more. That is why the household the savings have fallen. So as per the recent data, the saving rate is only 5% of the GDP. So which is 47-year low. And these are called as NPAs or non-performing assets. So NBFCs now, earlier they used to focus on secured lending category, but because of the shift, now they are focusing on the unsecured lending, especially the personal loan segment, because of the intense competition and the ease of availability of loans. And so that is why it has created intense competition. And so they have to lend to keep their operations afloat. And at the same time, they have to reduce the lending rate also. That is why it is hitting the NIM. NIMs are nothing but net interest margin. NIMs are the difference between interest paid and interest earned by any financial institution. In financial institutions and especially in NBFCs, the NIM is taking a hit after the heavy competition. And the shift in focus of NBFCs, they are focusing more on the personal loan, which is actually triggering or aligns the RBI's action now. So what ultimately it will lead to, there will be higher cost, not only for the capital cost for the banks and NBFCs, but there will be higher borrowing cost, interest cost to the borrowers also. Slowdown is expected, and increase in risk weights affect the capital adequacy of the banks. So capital adequacy is stipulated by RBI for banks and NBFC, that will be affected. Now they have to raise more capital because the risk weight assets are more. So ultimately it affects the profit of the banks and NBFCs because of the increased capital requirements. And capital adequacy actually ensures, as per RBI, it ensures the financial institution, they have the sufficient capital to absorb in case of any loss. So actually the capital adequacy and regulations all meant for bringing sustainable lending practices and risk management framework. As per RBI norm, there are different capital adequacy ratio for banks and NBFCs. In case of PSBs, public sector bank, the minimum it is 12%, and private sector banks it's 9%, and NBFCs it's 10%. So the banks, they are NBFC, they have to raise the capital, especially tier 1 capital. Tier 1 capital is the high quality capital of the banks. The Standard & Poor, another rating agency, they are estimating that there will be a drop in tier 1 capital because of the recent measure of RBI, and it makes the weak lenders or the weaker financial institutions to raise the capital. And the impact of CRAR, capital to risk weighted assets, Tier 1 CRAR is calculated based on the Tier 1 to risk weighted assets. Total CRAR is calculated by combining the Tier 1 and Tier 2 capital to the risk weighted assets. Tier 1 capital is the pure capital or high quality capital, which consists of share capital, disclosed reserves, and banks, which is actually banks' high quality capital fully available in case of any need to cover a kind of loss. Whereas the Tier 2 is undisclosed reserves and revaluation reserves and any other provisions, loss reserves, and hybrid capital instruments and subordinated debt and investment reserve account. Thank you for watching Learn by Choice. Please subscribe to it for more and more educational videos. We value your support.